Hello and welcome to the Financial Puzzle Playbook with your host, Jim Sumpter. I'm RJ Malik, producer of this podcast. And of course, we've been talking about the 6 puzzle pieces because this is a big part of your podcast, Jim. So, what piece of the puzzle are we going to be talking about on this podcast? And while you're at that, why don't you introduce your guest, too?
I will absolutely do that. Thanks, RJ. So today, well, first of all, this is Andy Graffeo, and we have let him out of the office today a little bit. He is the other part of CMC Financial. So he's a guest, but he's also my partner. And today we're going to be talking about something that we get a lot of questions about this time of year. It's end of the year tax planning. So we're going to talk about income tax, but specifically charitable contributions and ways that you can give money, give items, give things to charity and take a tax deduction. Before we jump into this, Andy, since we finally let you out, why don't you introduce yourself to the world?
All right. Hello, everyone. Andy Graffeo, lifelong resident of Birmingham. Joined the group probably 20 plus years ago. Grew up in the retail business, but it gave me a leg into the financial business, what I dearly enjoy.
Absolutely. And so Andy and I have been working together for a few years now. Again, he is another member of CMC Financial, does a lot of tax work, a lot of tax planning. And so this is a topic, Andy, that we get a good bit of. And, people will ask us, if you give a donation by check or cash, first of all, is that allowed? And then what are some things around that we might want to make sure that they have?
Well, first thing you got to remember, it's got to be a reputable 501c3 organization. And that's probably some of the big drawbacks on it. They have these GoFundMe accounts and those type things, and personal checks aren't really tax deductible. So you want to make sure it's a reputable organization. The check is made out to them. And it's usually a good idea to even make a copy of the check, whatever. Generally, the rule is if it's under $250, it's not necessary to have certain documentation, but we always advise to have that. You just never know down the road, you have to prove it.
So it's a best practice really to get the letter that the charity is going to send to you.
That's correct.
Right.
Generally, they'll send you a follow-up letter with your donation, and you can kind of put that together. You just don't know down the road about having to back that up.
Absolutely. So you mentioned the $250.
Yeah.
So if I'm writing a check, or if I'm giving to my church, or whatever organization it is,
Yeah.
and it's under 250, then I'm basically using my check or my credit card receipt. If I put it on credit card, I'm using that as my proof.
As your
but the IRS doesn't require any documentation per se. But if it's over $250, then we have to get the letter from that charity.
That is correct.
Right,
That's
right.
usually the guideline right there.
Right. Now, have you ever had clients that come in? You mentioned the GoFundMe, because
Yes.
I get that a lot.
Yes.
If somebody comes in and they say, oh, well, so-and-so is going through some sort of a challenge or an illness, or their home, had some flooding or a fire or something. So somebody set up a GoFundMe. So you're saying that doesn't count?
No, it really doesn't. We had a situation, and I said, you know what? Let's make the check to the church, then let the church in turn reimburse that person or that family and give them the donation, because it would not be deductible to write a check to, of course, me, you, or the individual. That is correct.
Right. So it has to be a qualified charity.
Correct.
Which is a 501c3. Those are actually, you can Google.
Right.
And the IRS has a long laundry list, because they have to be approved by the IRS.
That's correct.
To be a 501c3
Right.
on that. Are there any exceptions to this $250 rule?
Of the non-cash? Is that what you mean?
Yeah.
Well, in this day and time, as we clean out our closet, everybody's got plenty of stuff left over.
Right.
So if you have non-cash deduction, there is a limitation there of the $250.
Okay.
But it's also good to kind of maybe write down what you gave. And I always get asked how much. I said, well, think of it as what we call it, thrift store. If you had a garage sale of how much would this chair or this suit sell for, what would you get for it? And we give it what we call a fair market value.
Okay.
And there's, everybody asks, well, what's the limit? There's really no limit I always like to put what I think is fair,
Mm-hmm.
because the last thing somebody wants to get is a letter from the IRS saying, hey, we want you to approve all this.
Right.
So,
Right.
and that's popular going forward because we do see a lot of that in our tax work.
Yeah. So I know when we got ready to move a couple of years ago,
Yeah.
that was the time that Jennifer and I would clean out our closets or clean out the garage, or, you have 8 frying pans. You really only need 3 of them, things like that.
Yeah.
So what we did is we collected a lot of items and we gave them to, Goodwill or
Right.
the Salvation Army or something like that. So
Correct.
one of the things that we did is we had multiple bags,
Yeah.
and we didn't do all of this in one day or over a
Sure.
weekend. We did it over a period of time. So we would make several trips to the donation drop off, and every time, I said, okay, get me a receipt. And so what we did is we made a list of all of those items. I think it's a best practice to take a picture. Everybody's got a cell phone today, so it's super easy to snap a picture, and then say, okay, we donated this on X date at this place, and they gave me the receipt.
Yeah.
But at the end of the year, I think I had like, I don't know, 8, 9 of those receipts, and each receipt may have had $200 to $300 on it. So if I remember correctly, I could add all of those up, but then there's a different filing requirement that we as tax professionals actually had to do. And it's a 82,
8283 is a form to put that down.
Yeah.
And I've spent countless hours
Right.
itemizing that stuff.
Right.
And people kind of throw it at us, but I said, give me an itemized list of what you gave, because I don't
Right.
know what you gave, and then we can get a monetary value.
Right. Right. And then here's what happens is somebody comes in and they have, let's say that they may have $2,000 or $3,000
Oh, sure.
of, of all these different added up receipts. You put it on that form, and at that point you have to, if you use the 8283, you have to say, how did you obtain the item? What was the cost or approximate cost, and what's the fair market value of that today, or thrift store value?
That's right.
Garage sale value is another one that you can use. And there's websites and there's different places that'll sort of give you that idea. What you can't do is say, well, I spent $25 for the frying pan, so now it's worth 20.
Right.
That doesn't fly.
No, exactly.
It may be worth $5 or so.
$5 you hope.
Yeah,
There
so
you go.
something like that. So all of a sudden you need a lot of those to start adding them up.
Right.
Okay, so what we talked about, this $250.
Right.
What if something is over $500? I hear a lot of times, these advertisements, to donate my car or donate my boat.
That's
or
right.
donate a trailer. Have you ever had anyone do that? And then what do you have to prove if you do that?
I've had someone donate a car, and
Okay.
we had to get a appraised value
Okay.
from the company that took it. But they sent her a sheet that had the fair market value of the vehicle, the VIN number of the vehicle, and everything.
Okay.
Because I think it was $6,000.
Okay.
So
Okay.
yeah, we were able to have that. So once you get into the higher dollar amount, you really need good documentation. Have something from the organized charity,
Mhm.
how much it was, what it was, and described, and all like that. And most of the time, if you have that, it's really not a problem.
Right.
Yeah.
So really the keeping the good records is
That's
the,
right.
is the key.
That's key.
Okay.
Very key.
Because I know if it's over $500, but less than 5,000, you have to, how did you obtain it? What's
Right.
the cost? What's the fair market value? If it's over $5,000 value, then you have to have that appraisal.
Correct.
And that's the one big distinguishing difference.
It is.
Yeah.
Once you get in that higher dollar amount, because it could sway your taxes either way.
Right.
And hey, why did you get such a huge refund? Well,
Right.
we donated this vehicle, boat, whatever it may
Right.
be. So
one thing I think it's important too that we want to share is, what we're talking about here on these charitable contributions, at least at this point, is that you would have to itemize your deductions in order to take advantage of this.
that's correct.
And so if someone took a standard deduction, but they had all these charitable items, they may not be able to use it this year. So what's going to happen is you can carry that over to the next year. You can actually carry over for 5 years.
Yes.
At the end of 5 years, that carryover goes away.
It does.
It
Correct.
does. The other thing is the 60% rule. So you can only donate 60% of your adjusted gross income
That's correct.
each year. So, I kind of like to look at it if if your adjusted gross income is $50,000, you can only donate 30,000.
Right.
And we're going to get into in just a minute what happens if you donate like highly appreciated stock and things. And that's where these numbers can get really, really a lot higher. But right now we're dealing with you have to itemize your deductions.
Correct.
And then have you ever had anybody that took the standard deduction on the federal, but they itemized on the state?
And that's what's been going forward, Jim, the last, I guess, 4 or 5 years with the new tax plan that's set to expire in 2025. But first of all, I tell them, I said, look, get the receipts. Let's get it together. It'll help on the state.
Yeah.
And I do have some clients that will kind of double up in 1 year, say, Andy, I'm going to give more deductions in 2023 and do more. And then in 24, I'll back off where I can meet that threshold to itemize. So with the higher standard deduction, it is difficult on the federal, but again, it helps a lot of people on the state of Alabama.
Okay.
Sure
So you said something that was interesting, which I've had some clients do too. I think it's called stacking your deductions.
Correct.
And so what you're saying is if let's say you have more charitable in 1 year, then you want to give all of that in 1 year, and you might itemize, say, in 2024.
Yeah.
But then in 2025, you're going back to the standard deduction. So you can do that. So you don't have to have the same every year.
No, you don't.
Okay.
And it's stacking them together. If they know they're at that close threshold, they'll say, I'm going to my church organization, I'm going to go ahead and give that extra amount, and then let them know. So, hey, I'm doubling up in 24.
Yeah.
But in 25, I may not have as much. So anyway, but that's a very popular way to use your itemized deductions right now.
Okay.
Sure thing.
So, I have a client that wanted to create a legacy with a couple of endowments or basically at a school. And then I think maybe a philanthropic organization through a fraternity and stuff like that. So one of the things that they did is they took out a life insurance policy. Basically what they did is that the policy is on their life.
Correct.
Okay. And then the owner of the policy is the charity, and the beneficiary of the policy is the charity or the endowment or school or whatever.
It is.
Because they did not have any ownership in that policy, and the policy was given to the school, and the school is basically going to benefit, they were able to take the amount of the premium that they paid every year as a charitable deduction.
Correct.
And so this is a pretty good strategy because sometimes we have people that want to create a legacy.
That's true.
And they want to give to their college or their sorority or their fraternity, or I know you're a member of Knights of Columbus, and so if you wanted to do something with that,
that's true.
You could give that policy to them.
Right.
And this is a way, that's another way to do it. And sometimes end of the year planning and things like that. Let's talk about donor advised funds just a minute. Have you had clients that did that?
I haven't had any, but I think it's coming more popular now.
Right. Okay.
It's a great tool to use. I know you've had it in your practice to use for people where if they want to set up something of appreciated stock and they say, hey, I don't really need this stock, and I know it's going up tremendous in value because I've had it so long.
Right.
I could donate it to one of these organizations and get the tax deduction for it. I take that back. I do have a guy that did that. He did the charitable remainder trust, which is similar, where he's going to give it to a church, but he's going to take a little bit of income now, and at his death, the value of $50,000 or whatever the value is goes to the church.
Right. So, charitable remainder trust, charitable lead trust, charitable annuity trust, things like that. That's what I call charitable planning on steroids.
Yeah.
because those are the type of plans that you really have to set up a specific document, give a specific dollar amount, and it's generally larger dollars when we have somebody that does that. But it absolutely is a fantastic strategy. Now, if we do the donor advised funds, because I know like Schwab has one, Fidelity has one. I have a couple of clients that maybe there's a religious organization that has a donor advised fund. You mentioned highly appreciated stock. So
Mhm.
is that where, like, let's say I buy the stock for 10,000
Yeah.
and then and it's worth 50,000 today. Okay, so if I own that stock and I sell that stock, what happens?
Well, if you sold it on your own, of course, you got capital gains there.
Okay, so I would have to
Right.
pay the capital
You had
gains
to pay the
tax.
capital
Okay.
gain. Where if we used the donor advised funds and we donated it to the church or organization, whoever
Uh,
it may be, they will absorb it. But because they're a nonprofit, there's
mhm.
no tax due. So you, as the owner, you don't have that tax bill hitting you. Instead of you saying, "Hey, let me go ahead and sell 10,000 shares," now I got to pay the tax. Then I'm going to give the money to the charity. Why not just jump the hoop there and give it straight to the charity and let them absorb the appreciation and tax? And of course, they owe no tax on
And
it.
in this
So
case, the charity is the donor advised
they
fund.
don't. That's correct.
So let's say that you and Mona had that situation. Y'all might set up the Graffeo Charitable Foundation.
Foundation.
Okay.
Correct.
So you've set up a donor advised fund. So you've given that 50,000, but you only paid 10,000 for it.
Right.
Okay. Are you getting the $10,000 deduction or are you getting the $50,000 deduction?
You're getting the fair market value of that.
So the
The
50,000,
50,000.
you're getting the 50,000 today,
Yeah,
but
of what the value is of it today. Correct.
there's no tax due to
There's no
you
tax due because we donated it
because
to
you
the
donated
charity.
it to the charity.
Yeah.
Okay, that's
Yeah.
a good
It
strategy.
is. If you find people that want to really use it, I mean, you have the charity and you
Mhm.
know you don't really need that income or that particular stock, whatever it may be that you bought way back, like an AT&T or
Mhm.
McDonald's or
Mhm.
Southern Company, it doesn't matter. All those that have appreciated so much.
Yeah.
That's a good way to use that. It really is.
Well, and one other way that I've had a couple of clients use it is they were gifted stock.
That's right.
So when they received that stock as a gift, they were given the basis of, say, mom or grandma or granddad or whoever gave it to
Right.
them. So it's not something that you necessarily have had to buy, but if you're gifted that basis. The other thing that you can do is if you have like land, like let's say
Yeah.
you have land that's appreciated, you could do this same thing with land.
Yeah.
It doesn't have to be stock or a bond. It could be land. It could be really any kind of tangible asset
Right.
or a capital asset that would have that gain in
Right.
it. Right.
Correct.
Right.
And those are popular going forward. I believe you're going to see a lot of that.
I would agree.
Yeah.
Hi everyone, I'm Cassidy, the second C in CMC Financial. So dads sometimes get on a roll with this podcast and might forget to remind you about a few things. 1, don't forget to like and share this podcast and leave a review. 2, follow CMC Financial on all of the socials, Facebook, Instagram, and LinkedIn. And 3, go check out the website at cmcfp.com. Okay, back to my dad. He's probably still talking.
One of the last sections that I really want to talk about here is a strategy that a lot of our older clients have done. And this is what's called a qualified charitable deduction. Okay. So this is where if you're over 70 and a half, you can do this.
Mhm.
If you're under 70 and a half, sorry, but you can't. Okay. So in disclosure, Andy, you could do this. I couldn't.
So we're not telling.
So yeah, but we're not saying anything. No, so how does this work? So this is where you have an IRA or a SEP plan or a simple IRA, something like that. What are you doing here to make this strategy work?
What we see a lot of people have, Jim, is they've got an IRA that they've had for a long time, and now it's time to take their required minimum distribution, which
Mhm.
we get to call a lot. You do too. That I don't really need the money now.
Right.
What can I do? And we set up these qualified charitable deduction. We call them QCD,
Okay.
and the money, instead of them taking the RMD and taking the money and paying the tax, we can donate it straight to the charity. The charity absorbs it again, no tax due because they're a nonprofit, and they forego having to pay tax on that IRA money.
Okay. So for example, if I wanted to give, let's say that my required distribution was $20,000.
Correct.
And I wanted to give $10,000 to XYZ charity.
There you go.
Okay. What you're saying is I could take that $10,000 directly from the IRA and it goes directly to the charity, but I can't take the distribution and then write them a check. That doesn't work, right?
As soon as you get that check, you've just made the distribution, boom, taxes due.
Okay,
so we want it to go straight to the
it goes
charity.
straight to the charity,
Right.
and then I'm only paying income tax on the 10,000 that I received.
Right.
Yeah, because I still have my required distribution, the
correct.
full amount.
That is correct. And that's a very popular too.
Mhm.
If you have to take that much, you go, well, I'll keep a little bit, but I would like to make that
Yeah.
deduction there.
Yeah.
And give it to the charity.
Andy, that made me think about, I did a podcast a couple of podcasts ago where we talked, I think the title of it was, I've inherited an IRA, now what?
Yeah.
Okay.
Yeah.
And we talked about inherited IRAs. One thing that I will point out, this strategy does not work for inherited IRAs, even if you're over age 70 and a half.
Correct.
This has to be from your own IRA.
Right.
The other thing is, a lot of times we'll have business owners that may have a SEP plan or a simple IRA, that maybe they're still working a little bit. If you contributed to that SEP plan or to that simple in that same year, you cannot use a QCD and a contribution at the same time in the same year.
Correct.
So, the one thing that I'll point out on a lot of this, and, you and I both do a lot of tax planning, but if a client has an accountant or a CPA or their estate planning attorney that they work with, we are going to always advise on any of these strategies to talk to them, because everybody's different.
That's correct. That's so true.
Would you say this is an easy part of the tax law or a more complicated part of the tax law?
Probably much more complicated.
Much more complicated. I would agree with that.
And you just got to make sure, if it's Schwab, Fidelity, whoever you're using, make sure to get the paperwork right, because soon as that's done, November, December, January, it's hard to pull it back if it's not done correctly.
Right.
Yeah.
Right.
Yeah.
Well, Andy, this has been kind of fun. It's end of the year tax planning.
That's right.
This is one out of many, many, many end of the year strategies, but we thought it would be appropriate to do that and to kind of talk about any final thoughts on just charitable giving in general. Any last minute tips?
I don't know, Jim. We all want to be nice and charitable, and I think we just need to be careful of the organizations. Make sure it's reputable, for what you're doing, and it's going into the right places. But, I hear so many people, I want to give it because it's the right thing to do.
Right.
I'll worry about the tax deduction later.
Right.
And that's really important. So,
Right.
good deal.
Right. Well, and that, we brought up the donor advised fund, and then we brought up also the GoFundMe accounts.
That's right.
Because that's something that we see a lot, and we've had hurricanes this year.
Oh, yeah.
Where somebody will give to such and such organization because they saw it on Facebook and it seemed like the right thing to do.
Correct.
I would just caution everyone, there's a lot of rules around this, and you have to make sure you're following all the rules.
That's true.
And that's why I mentioned always talk to your tax advisor, your estate planner, your financial planner, just to make sure you're qualifying yourself all the way through.
And it's like you said, it's easy to look up, make sure they're a reputable organization.
Yeah, exactly.
Very
well,
good.
RJ, I think we've totally exhausted this very simple topic. Do you have any questions on any of it?
No, I don't. It sounded really good, and it was very well explained. So it was simple.
Okay.
It was easy to follow, which is always a good thing, and
right.
very encouraging. Before you go, Jim, contact information. We need to give that out.
If you want to contact us at CMC Financial at cmcfp.com. We're on all the social media channels, Facebook, LinkedIn, Instagram. We have YouTube as well. My direct number is 205-510-9074. And Andy, why don't you give yours?
Mine is 205-397-2456.
Okay.
Good deal.
Awesome.
All right, that sounds good. And okay, most importantly, thank you for listening to the Financial Puzzle Playbook podcast. We ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at the Financial Puzzle Playbook, I'm RJ Malik, and we'll see you at the next podcast.
Thank you for listening to the Financial Puzzle Playbook. Click the follow button to be notified when new episodes become available. Don't forget to follow us on social media by checking the links in the description. And contact us today by visiting our website at www.cmcfp.com or give us a call at 205-510-9074. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of CMC Financial. It does not necessarily represent those of RFG Advisory, Private Client Services, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by CMC Financial or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services, CMC Financial, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.